How long were you in as a chemical engineer before you figured out your real thing?
7.5 years. In the middle of that stretch, I got married, and my wife had the same idea and mentality. We
Mm,
tried all kinds of crazy little businesses from like flavored popcorn, flipping cars, vending, all that. We looked into all that stuff. And each one of them were like, okay, this could work, but it's going to be probably an even harder job than what we're currently doing.
okay.
And I don't know about how much upside there is to it. And then in 2007, we discovered house flipping. And the short version is took us about 6 months. We got our first deal. When we sold it, we made as much as I made all year at my chemical engineering job. So I
Uh-huh.
quit, went full time. 2 years later, she quit, went full time. And then how we got to multifamily is in 2009 and 10, we had really good years flipping. But that also is a grind. You're only as good as your last deal. You sell the house, hopefully you made a profit, and there's nothing left to show after it, right? There's no income afterwards, you don't have any assets. You got to go out and get the next deal.
Yeah.
We said, well, what provides more lasting wealth in income, recurring income? We're like, okay, well, apartments. And then we reasoned, well, geez, we just had a huge recession. So that probably means we're going to have an expansion, which means job creation and household formation. And everyone and their mother either got foreclosed on and can't buy a house for the next 7 years, or everyone they know got foreclosed on. So they're scared to buy a house for the next 7 years. So we're going to have an expanding economy and tons of renters. Like, okay, we need to figure out apartments. And that is how and why we went into the apartment world.
Let me ask you back on you talked about you were doing flipping in 2009, 2000 you flipped, it sounds like, through the 2008 crash and all that stuff. Did you guys get stuck with any stuff? What was some nightmares any nightmare stuff happen in there?
No, we never lost money on a single flip. It never took us more than 30 days to sell a property. And a couple of reasons for that is generally you want to go do the opposite of what the headlines and the crowd is doing. So generally, like if you're looking to buy real estate in particular, but this applies to a lot of assets, the time to buy it is when pessimism is at the greatest peak, right? So in 2007 and 8, I remember walking into escrow office with actually, I believe it was our second or third flip. And there was a real estate agent sitting there, and he's one of the top ones in our city. And he looked at me and goes, "Are you crazy trying to flip a house right now?" But there's no such thing as a bad market, just a bad strategy. So in Southern California, there were condo complexes here where prices dropped 70%. Like a
Okay.
condo that would sell for 400 would be literally selling for 100 2 years later. And that's 75%, but that stuff happened. But what we would do is we had no competition. Nobody else was buying. And so we would buy something for 55 cents on the dollar. So almost about half of what it was worth, fix it up, and then list it for 80 cents on the dollar. So even though prices were coming down, if a property, just to use round numbers, was worth 100,000 on, we would list it to sell for 80. So that even though there was almost no buyers out there, if there was one buyer in that neighborhood, they're coming to our house because it's the best condition because we just renovated it and it's a better deal than all the other ones.
Yeah.
And so by doing that, the worst deal we ever had was one that the renovation was way more than we anticipated and prices were coming down really fast. And we made like $4,500 on it, right? Which on a $500,000 house in Anaheim, that's a pretty scary thin margin. But everything else, we actually did quite well because no one was out doing it.
Did you guys have cash? Is that how you were able to purchase the properties, or were you mortgaging things? How was that working?
No, you do need to have cash to be in real estate, but it just doesn't have to be yours. I remember that we opened escrow on that very first deal, and part of the contract is we owed this guy Steve $145,000. That was his net proceeds after paying off his loan.
Okay.
We didn't have that money. But I just knew like this is a really good deal. We'll figure it out. And I walked, it was a bit nerve-wracking our first deal. So I had invited a realtor friend to come to the escrow just kind of like as moral support. And I walked out the door after, getting it set up, and I turned and I said, "Hey, Bob, Linda, do you guys have 140 grand you'd like to invest in this?" And they looked at me like, "Nope, but we know somebody who might." And turned out their broker did hard money loans. And so he loaned us the money at like 10% interest and 2 points. We got closed, we fixed it up, sold it, paid him off. And he funded, I don't even know how many houses over the next like 4 or 5 years. He funded every deal that we asked him to fund. And so we did eventually, as we got going, we had the money for renovations and all this stuff, but we never bought a house with our own cash. It was always private hard money loans from a guy from him. And then over time, people are like, well, hey, how come you didn't tell me about this? I've got money. I'm like, I didn't know. And so we had actually built up a list of people who we would have to cycle through and all right, it's your turn. So it worked out
Yeah.
well.
Yeah. So, and that's really, really, really key is yes, you need cash. It doesn't have to be your own. And I think a lot of the good grades in school people always want it to be their own thing that they like, I don't have enough money. I got to save up my money so I can do this. Not necessarily. You got to know people who have money willing to invest and trust you to put their money to work. So that's really, really important thing when it comes to investing in real estate investing in particular. So you went from your flipping, which is a job. I don't want anybody to
Mhm.
get the idea that because you watch HGTV and it looks like so much fun. And yes, they have a problem here and there, but they always get through and they always make a lot of money. That's stressful. It is another job. If you have a job, I don't think you want to be flipping. You need to
No.
make that your job. So then you guys realized that that wasn't the way to build your wealth necessarily, because once you flip that thing and it's gone, you gotta find the next thing to do. Nothing you don't end up owning anything but the cash, and cash is not really much to own, right? What's it do for it's good to do something with, right? Okay.
Mhm.
So then you decided multifamily with all the thoughts that you had, which made perfect sense. I don't know if I would have thought through all of that like you guys did. It's like, this is what the economy's going to do. We're going to expand. We're going to have people that can't buy because they just got foreclosed or they're scared they're going to get foreclosed because their family got somebody they know got foreclosed on. So we're going to have this whole economy of renters. How did you take classes? Did you read books? How did you jump from flipping to multifamily?
So our first multifamily deal was a 92 unit, mostly vacant property in Macon, Georgia, on the other side of the country. And yeah, you do not want to just run out and, that's not a flip, right? It's not a house. And so what we did is we had two coaches for flipping,
Okay.
not at the same time, just one after another. And so once we had made the decision to go into apartments, I literally just called one of them. Was like, "Hey, do you know anybody that we can learn apartments from?" And he's like, "Actually, I do." And he connected us with a guy who had already bought about 800 units. And we hired him as a coach and
Okay.
learned the business from him for about a year. He just walked us through. We'd send him the deals, and he helped us guide us through that first acquisition. No way we would have done it without that, the confidence, the knowledge. It would have been really dangerous to do it without the knowledge. There's so many things that can go wrong when you're buying
Yeah.
big stuff like that. And interestingly enough, we got along so well that we actually partnered and did like 5 or 6 more deals together as a team after that. But yeah, we hired a coach.
Okay. So, and you didn't buy in California, you bought in Georgia, halfway across the country. Did you go there and see it? How did that work? How did that whole thing work? And the reason I'm asking this question like this is because I know physicians in California who want to buy in California if they're investment properties in California because they want to be able to look at them. And I was like, okay, you can do that. You could probably do better if you did some other things. So how did you come from being in California and then getting to Macon, Georgia and buying your property over there?
Yeah, you're absolutely right. It actually can be a big negative to have a property, to own a property that's close to where you live. And it comes down to your identity. If, like, for example, I've known some people, there's a firefighter on my street where he retired, he had 8 rental properties, and that was just the thing he did was manage those. Perfect. That's a good fit for his lifestyle. However, if you are an investor or if you are a busy professional, your time is worth more than running out to check on a leaky water heater or a squeaky hinge on a door or to be changing light bulbs. That is something that should be outsourced and it's a business expense. It's not something like, well, I want to save money and I'm going to change the light bulbs. Actually, put it in your lease that they have the tenant changes the
Change
light
your own
bulbs.
light
But
bulbs.
yeah, you know, you don't want to be running out unclogging toilets. I mean, that your time is more valuable than that. Either working as a surgeon or finding the next investment property or just spending the time with your family, right? There's a professional who that is their living to take care of that. So just factor that into any investment you're going to do ahead of time. And so one of the benefits of having stuff across the country is you can't do that. You cannot give in to the temptation and just, well, I'll just run over there and take care of it. And then again, if you're, that's going to be what you want to do. I know people like that is there. They've got like 100 rentals. That's all they do and they enjoy it. That's
Yeah.
fine. But if you've got other things in life, that is not a good way to go. And so that is one of the reasons we went ahead and bought on the other side of the country. Now the trick is make it is the management. When you have something on the other side of the country, what makes it work is finding the right people to manage it for you. But and get back to the beginning of your question, absolutely. I was spending a lot of time in Georgia in the beginning, and again, my intent was to make a business. Like this was what we were going to do full time. So I'm flying out to Atlanta regularly and then driving down to all the different cities. In this case, it was Macon, Georgia. And I spent a long time at the property, both before we bought it to check it out. And then, of course, once we did buy it, I was spending even more time out there. So,
Yeah, yeah. And you had a mentor. You didn't just go off to Macon, Georgia, see a building that's 92 units empty and say, "Oh, I'm buying that," off on a whim. There was somebody helping you make the decision and work through all the potential problems there are gonna be with this thing. So, you did pay this person to help you, right? It wasn't just like
mhm.
and another thing I find people get caught up in is, "I gotta pay somebody to help me, to make me help me understand." It's like, you want them to be there, and if you're not paying them, they're off doing something else to get paid. So it's a whole mindset around building your business. It's just like when you went to medical school or when you went to law school, you didn't go there and have a lawyer off the street who wasn't getting paid teaching you. You were
Well,
paying them to teach you. So this
yeah, my real estate education in terms of what I paid cost less than my college degree, but it's made me far, far more. No, don't get me wrong. The college degree was great. It was worth it. But
yeah.
yeah.
Yeah, no, 100%, 100%. Okay. When did you become Vantage Point Acquisitions? When were you like, "Yeah, we're in." It sounds like you were in 100% a long time, and then you just were, like, going all in, and we're gonna help other people do this too.
Yeah, we became Vantage Point Acquisitions once we got that first deal, right? We're like, "Oh crap, this is real now." Like we're buying 92 units, we got to raise money, we're going to have, people hired running this, and so that's when Vantage Point started. And just cuz people ask, "Well, how is it structured?" It's essentially when you buy something that's 100 units or even 10 or 20, a sizable property, generally speaking, one of the best ways to do that is to just put it in its own LLC.
Mhm.
And so each asset has its own specific LLC, but you got to tie all that together somehow.
Right?
And so our entity is the one that essentially manages all these separate properties. So
Okay. Alright. And then so you were up until then, I know you were working with individuals when you were doing your flipping. Are you now full on syndicating with multiple people investing in your properties, or how's that working for you guys?
yeah, it's actually all still individuals, but it is syndication. It's just now there's a whole lot more individuals. So that first deal, we needed $140,000, and there's one guy who provided that. Now, where anywhere a deal might require up to the biggest one I think we've done is a little over $21 million, and we do what's called 506B, which is just SEC rules. And what that says is there has to be a pre-existing relationship. So we don't advertise. You won't see our deals on LinkedIn. I don't mention them on stage when I speak. I don't post them on Facebook. Like you have to be on the list in advance. And that's how we fund our deals is we've got, I want to say about 1,400 investors just over time that have just word of mouth, referrals, repeat investors that have asked to be on the list. And
Mhm.
then I think there's roughly about 300 that tend to be pretty active. So that's where all of our equity comes from. It's just private word of mouth, people on the list. We don't do institutional money. Like I said, we don't advertise. And all 2,800 units have been funded that way.
Perfect. Tell me your worst deal. Actually, that's not I'm gonna give you an option on what's your worst. The worst experience you've had in real estate investing.
Yeah, so that very first deal was a rough one, but I wouldn't be here today if I hadn't done it. And I learned a lot, and it still ended up being a really good investment. So that's part of what turned me gray, but it was very much worth it. The worst deal we did was was it it was number 4 or number 5. This was it. We bought it in 2013. It was a 350 unit early 1970s construction property in a very rough part of Dallas,
Okay.
South Dallas.
Okay.
And it was when we bought it, it was very distressed. The previous owner had a lot of issues. And so it had high delinquency, which means people are living there, but they haven't paid their rent. They owe you 3 months.
Mm.
And our thesis was to go in, and most people have probably heard, fix it up, clean it up, get rid of the criminal elements. We fenced the whole property, put up lighting and cameras and all that, try to make it a safe neighborhood and increase the rents to cover the cost of that. Well, we would renovate the units, we would successfully lease it for a higher amount, but then people would move in, and 6 months later, they'd stop paying the rent, and then we'd finally have to evict them, and instead of just moving out, they would, like, destroy the unit, and we'd have to, like, renovate it again. And then the property that old, we had pipe leaks, roof leaks, it's just stuff that's 50 years old and hasn't been taken care of, is falling apart, so it's very expensive to run. This property also had a chiller system, which for those of you who aren't in Texas and Oklahoma, you're probably like, what the heck is that? It is a single air conditioning system that runs the entire property. So there's literally one giant air conditioning unit, and then it pumps the cold through the entire property. So when you're in Dallas, Texas in August and that goes down, you have 350 very upset tenants and residents coming after you. And then, of course, well, I don't know rent because my AC turned off, and it's just a nightmare. The key mistake we made was that you can take a rough property and you can improve it, but you can only improve it up to the level of the neighborhood that it's in. And that was a rough neighborhood. And so we would try to bring the property up, and the neighborhood would pull it back down. And I don't know if you remember, but in 2015, everyone thought a recession was coming in 2016. Robert Kiyosaki even put out a book about the 2016 crash, right?
Mm.
And we looked at ourselves and we're like, hey, this is a rough C minus low end property. In recessions, those are the properties that get hit the hardest.
Yeah.
And we decided it is better to get out now and not lose any money than to keep going and risk getting into a recession and getting this worse. So we sold it early. Most of our properties, we plan on a 5 to 10 year hold. We sold this just after 2 years. And just one other quick story. We actually had somebody in broad daylight climb up on top of the leasing office, knock out the skylights, and throw Molotov cocktails into the leasing office with our people in there to try to burn it down. Like, this property aged me like 5 years. Um, so we sold it early. Again, our number one goal is don't lose money. And so let your winners ride, cut your losers short. And we didn't want this to become a loser. So we sold it. We ended up with I think investors got a 5% internal rate of return and like a 1.1% equity multiple. So if you put in 100, you got 110 out over that whole 2 years, which is obviously not what we were aiming for, but
But you didn't
eh,
lose. You
yeah, but
didn't lose.
we wanted to make sure we didn't lose. So that is the worst syndication we've ever done, both in terms of financial returns, headache, lessons learned, etc. And but the good part of it is you always learn the most with your mistakes.
Yep.
And so because of that property, we really dove deep into what went wrong. We created a very thorough, extensive screening process that ensures we will never ever buy anything close to that again. And there's been headaches and stuff along the way, but nothing like that ever since. So
Yeah. I think one of the things I think about when you're thinking about improving a neighborhood, you gotta be in. You're gonna improve the neighborhood, but you're gonna pay when you're doing the first thing you're improving, it's gonna be painful. Just what you said, the neighborhood's gonna keep pulling it back down until you can finally bring up the entire block, whatever you're buying. I have a friend that buys a block and like, I can fix this block. And then that's better. And then, but to put one unit, one property that's 100 units and that's tough. God,
well,
good
yeah, and
job.
that's what it was, is there was a couple thousand more apartments all surrounding us, and, like, those guys weren't helping. I'm saying that we have
Exactly.
no
Exactly.
control. There'd be a shooting at our property, and they'd just hop the fence and run into the next one, and
Yeah.
those guys didn't care for whatever reason, and it's like, "Okay, we can't." Yeah.
Yeah. I had a friend of mine who bought a property and one of his first properties in San Antonio. And he said the worst day was when he saw his property on the news from California.
There's never maybe I have never seen a good reason for your property to be on the news.
It's not like, "Wait, that's my property. What's going on?"
I've had a similar experience. It's not a good one.
That's yeah, yeah. Owning real estate can age you. Did you ever do single families besides the flipping? Did you ever, like, control stuff like that just on the smaller scale?
Yeah, so when we were flipping, another disadvantage to flipping is you're doing it so short term that that's taxed as regular income. So
Mhm.
you pay more taxes on that flipping income, whereas you invest in multifamily or a syndication. Number one, you've got depreciation, so you probably won't pay any taxes for 4, 5, 6 years on it.
Right.
And then even when you do, it's usually at capital gains rate, which if you're especially if you're in the medical field, you're in the higher tax brackets. Well, the gains on a multifamily investment or even a house, if you hold it long term, are going to be taxed at probably half of what you're paying. We did keep one for, I don't know, I guess it was a year and a half or 2 because when we bought it from the owner, it had a tenant in it,
Okay.
and she was a good seemed like a good person and like, "Well, we don't wanna just kick you out, so as long if you keep paying rent, we'll just let you stay here." And then, like, a year and a half later, she gave notice, and at the time, we were buying a house ourselves, and we said, "Perfect. We just when she moves out, we'll just fix it up, sell it, and then we use that to help buy our own house." That's the only one that we kept as a rental.
Yeah.
California can be tricky if you're trying to run rentals, so
Yeah. I know a lot of the physicians that I talk to, their first when they talk about real estate investing, what they're thinking about is buying a house that they're gonna rent out and they're gonna manage and they're gonna do all the stuff on their own. And I'm just like and we did that. We had 18 properties, we were running them, we were managing it was a pain in the butt. It's just hard to do and have a job, another
Oh,
job
yeah.
you have. Like, if somebody's gonna do it and that's what they like to do, because there's some people you gotta deal with that you may not they're not gonna yeah, this that was a whole thing. Hearing
Mhm.
people's story, and you gotta be it was such an interesting thing. It's like, "Well, I can't pay my rent today, but I'm gonna have it by 2 weeks from now because da 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 da." And you got a heart 'cause you're a doctor. You people you wanna take care of people, okay, and you're losing the whole time, so get a management company. If you wanna do it that way, get a management company. They can be the hard guy, or you always wanna have somebody you can say, "Well, I have to talk to my partner about it," so that you don't have to be the one to be responsible for telling these people what they really need to do. So
Yeah, and I would say even if you do have a management company, which again I would recommend, it's still not passive at that point. You need to actively manage them and make sure they are doing what they need to do. And again, you definitely want them in the middle to handle the 2 a.m. calls about a plumbing leak and the story about my dog died and so I had vet bills and so I can't make rent, all that stuff. You want them in between. And also there's some safety reasons. There's other reasons why you don't want the resident to necessarily know you as the owner, but you still need to manage the manager.
you gotta
So
manage them.
you become an asset manager. They are the property managers.
Yeah. Yeah. I didn't even like being an asset man. I didn't like being the manager of the property manager. Like, oh, that was a pain in the butt. I'm like, "Look, I just wanna go I wanna invest in deals. Maybe I'll run deals again. I got tired of running deals. Like, I don't even wanna be the operator anymore. Let's just put money in somebody. Let me find great operators who do great deals, and let's invest with them." That's where I am right now, and that's where I'm looking to help people do the same thing, other women doing the same things. Like, you don't have to do it yourself. It's hard to find great operators. It's hard to
It
find
is.
people you can trust. I found all the bad ones, trying to all of them, but
Well,
I found a few of 'em.
these days we're getting much clearer perspective on which are the bad ones and
Mhm.
which ones are. And that is the closest you can get to passive investing in real estate is investing with a good operator. But even then, you still want to make sure you're asking questions, reading the reports, checking in with them. And there's nothing, unless you buy treasury bonds, that's probably the only thing that's truly 100% passive. And then a few other financial instruments. But yeah, what you're talking about is the closest to passive, but you still keep an eye on
Pay
your
attention.
operator.
You
Yeah.
still have to pay attention. You definitely still have to pay attention, and yeah, and so many of us just put our money in our 401(k) and don't pay attention to what's going on over there. So
Mhm.
this is at least when you're in operating with a syndicate or you have an operator, you have a person you can actually call and say, "Hey, I looked at this report. I don't understand this. Explain it to me." And they are going to explain it to you in a way that makes sense to you, not the way the stock guy talks and you don't even know what the heck you did. What did you just say?
And then just to follow up on what you said, I see a lot of people, people send me, "Hey, I'm thinking of investing in this or this." And one of the mistakes a lot of limited partners or investors make is, "Oh, well, this one says I'm going to get 21%. Well, this one only says 15. Well, I'm going to go with the 21." Well, number one, anybody can put anything on a piece of paper or a spreadsheet, right? Pro
Yep,
forma is Latin for pretend. Like
yep.
it's all a guessing game. And the real question is, well, how much risk is being taken to try to achieve those returns? And then what assumptions are going into it? So if you're looking at investing with somebody else, you really want to dive into what assumptions they're making. Are they assuming 7% rent growth for 5 years or three? Well, which of those two is more likely to happen? And we tend to get focused on the deal, but the deal is a small part of it. You're investing in the operator,
The
a good,
person. Yeah.
yeah, a good operator, even fraud and all that stuff aside. Let's just say anyone you're talking to is honest. A good operator can take a bad deal and salvage it and turn it into something decent. A bad operator can take a phenomenal ground deal and run it into the ground and turn it into a loss. So it's really about the jockey, not the horse.